Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at BURU.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
Today we are diving into a classic high-risk, high-reward puzzle. It's really fascinating.
It really is. On the one hand, you have this company, BURU, and they have this truly disruptive, unique technology.
But on the other hand, and this is the big but, they are wrestling with just acute financial stress.
Exactly. And we need to spend some real time unpacking this tension for you because it is the definition of a speculative turnaround play.
Right. So where do we start? The good news first.
I think so, yeah. If you only look at the core value proposition, the story is incredibly compelling. BURU's bullish case rests really entirely on its proprietary blue laser technology.
And this isn't just a small improvement, right? We're not talking about something that's just a little bit better.
No, not at all. It fundamentally changes what's possible in certain industries.
Okay, so when you say blue laser, what's the practical application? What makes it so much better than, I don't know, a standard infrared or green laser system?
It all comes down to absorption. The key is absorption.
Absorption.
Yeah. Traditional lasers, they really struggle to efficiently process highly reflective materials. Think copper, gold. Things that are essential in electric vehicles and next-gen electronics.
Because they just bounce off.
A lot of the energy does, yes. But the blue laser technology, it achieves superior energy absorption and much higher precision in these materials. So it's perfect for high-precision industrial applications.
Like what specifically?
Think ultra-clean cutting, heavy-duty welding, and really complex additive manufacturing, 3D printing with metals.
And that's addressing huge growing demand in sectors that are, they're just exploding right now. Automotive, especially EVs, and aerospace.
Critical industries, yeah.
Yeah.
Where precision and energy efficiency translate directly into huge cost savings. And crucially, the technology is protected.
They have a patent moat.
A very strong one.
Yeah.
They've built a robust intellectual property portfolio, patents, trade secrets. It creates a genuine high barrier to entry. Competitors can't just copy it overnight.
Okay, so that's the foundation of the whole bull thesis. It's strong.
It is.
But now we have to face the cold financial reality.
Yeah.
And it's highly contradictory. It's frankly alarming. I was looking at their 9-month revenue report, one ending in September 2025. The figure was just over $152,000.
Yeah.
That's a staggering drop, over 92% year over year.
And that top-line number is what scares investors off immediately, and understandably so.
Of course.
However, management has been really adamant that this massive decline isn't a sign of failure. They're saying it's a symptom of a deliberate strategic pivot.
So they're choosing to have lower revenue.
In a way, yes. They are actively walking away from older, low-margin legacy contracts to focus everything on the new tech.
So they are intentionally sacrificing current revenue to force this transition. It's an all-or-nothing bet on that blue laser.
Precisely. It's quality of revenue over quantity right now.
Yeah.
The bullish argument is that as these new product lines ramp up, the company will see a significant rebound. Analysts are projecting a return to aggressive double-digit growth.
Okay, so let's talk about the most critical, most confusing part of this, the actual financial health. Because I'm seeing two wildly different pictures.
It's whiplash. Initially, there were reports highlighting a relatively lean balance sheet, minimal debt. Some sources suggested total liabilities were around, $1.2 million?
Right, and they had a net cash position of about $900,000 earlier in the year. It looked manageable.
It did. And those snapshots, they created a sense of stability. It suggested they were being efficient even during this big pivot. But that picture was, it was obliterated by the Q3 2025 report they filed in November.
Okay, explain the scale of the distress in that report, because the numbers are shocking.
They reported a staggering net loss of $22.4 million for the quarter.
Wow.
But even more critically, the balance sheet revealed only $5.94 million in cash, which is very low for a tech company, set against a massive $67 million in total liabilities.
Wait. $67 million. How do you go from $1.2 million in liabilities to 67? That difference is enormous.
It points toward accumulated operational debts, accounting adjustments, the cost of the transition itself. But the bottom line is what matters most for you, the listener. Management was forced to explicitly disclose substantial doubt about the company's ability to continue as a going concern.
Let's stop right there. Because for our listeners, a going concern warning, that is not standard financial boilerplate.
Not at all.
That is management openly telling the market that without new financing, they believe the company might not survive the next 12 months.
That is the single most critical risk factor here. It overrides all of the technological promise. The liquidity crunch is real.
And it got worse, right? Because of operational failures. I read that they lost access to their main facility.
They did, and because of that, management had to completely write down all of their inventory and physical assets to zero.
Losing your facility, that's a textbook sign of severe stress. Probably couldn't pay the rent.
That's the assumption. And that action directly contributed to their liquidity issues and fueled that massive $22.4 million loss.
And the stress extends to governance, too. Another red flag.
A big one. In October, the company notified the NYSE American that its audit committee no longer met independence requirements. That's a problem for oversight when you're making such high-stakes moves.
On top of that, the shares are still trading with that BC designation. It signals persistent shareholder deficit, multi-year losses. A lot of problems.
They got an extension for compliance until October 2026, but the threat of delisting is a very real sword hanging over this stock.
So an existentially risky financial situation, but they're still making big strategic moves.
Which brings us to the next section. These strategic moves are being funded by highly dilutive methods.
And this is where it gets really interesting, and you need to pay close attention. The major move came in October. The binding letter of intent to acquire an Italian company, Orbit SRL.
Right. This is clearly designed to accelerate their market entry. The structure is a staged $5 million equity investment with a full buyout planned by the end of 2026.
And they changed leadership to match, right?
They did. They appointed two co-CEOs, Alessandro Zamboni and Mr. Bersoni, specifically to oversee the Orbit integration. So they're serious about it.
So the market is waiting for what? The definitive agreement?
Yes, expected around mid-December. If that happens as planned, it will be a major short-term catalyst. A bit of good news.
But funding all of this, given that $67 million liability number, it comes at an extreme cost to shareholders. The shadow of dilution.
Extreme dilution. They've been using aggressive tactics, specifically multiple unsecured convertible notes.
And for those who don't know, that means debt holders can convert that debt into company stock, usually at very low prices.
Exactly. And they have registered up to 38.3 million shares for potential conversion from those notes.
38 million shares, and that's not even counting the other issuance they did in September. Almost 20 million more shares, plus a ton of warrants.
So for a small company like this, the ownership slice for every current shareholder gets drastically smaller.
It's a huge headwind against any good news.
It is. And the market chatter isn't easing up. Rumors persist that they'll likely need another dilutive private round of financing, a PIE financing, just to get through Q4 and close that Orbit deal.
A PIE, private investment in public equity, usually means selling shares at a discount to institutions for quick cash.
Which would solve the immediate cash crisis, yes, but at the expense of severe and immediate dilution for everyone else.
It just crystallizes the whole dilemma. World-class tech, but management is forced to sell off the company piece by piece just to survive.
That's the tightrope they're walking.
So how is the market actually processing all this? Let's look at the technical indicators. Because despite all this turmoil, the stock has shown, well, a surprisingly bullish trend recently.
It has. Higher lows and higher highs. It tells us that some traders are discounting that going concern risk and betting purely on the tech and the turnaround story.
And the price is above some key levels.
It is. It's trading above its 50-day moving average, which is around 28 cents, and the long-term 200-day at about 24 cents.
So trading above those averages suggests that in the short to medium term, buying pressure has overcome that earlier selling pressure.
It signals some underlying strength, or at least conviction, among a segment of investors. But if you look at the short-term momentum indicators, the signals are a bit mixed.
How so?
Well, the stochastic oscillator suggests the stock is currently oversold. It might be poised for a short-term rebound.
Meaning the recent selling might be exhausted.
Potentially.
Yeah.
But the relative strength index, the RSI, is sitting right in the neutral zone at 38.55. So it's not screaming buy, but it's not wildly overbought either.
So a neutral short-term sentiment. But what's the overall technical outlook?
It's intriguing. There's a 3-month bullish trading range outlook that suggests the stock could potentially reach between 50 and 95 cents.
But that relies entirely on them executing perfectly.
100%. On closing the Orbit deal and providing clarity in Q4.
Okay, so let's list those key near-term catalysts. What should people be watching for?
Number one, obviously, is that definitive agreement for the Orbit acquisition in mid-December. That's the big one.
Then the Q4 2025 earnings report, mid-February 2026. That one is absolutely critical for the liquidity update.
To see if they survived. Then you have the rollout of new blue laser products. They have to translate to actual contracts and revenue.
And the January 13th deadline, we'll see if any big institutions are buying or selling.
And we can't ignore the speculative buzz, these unconfirmed rumors of a partnership with a major automotive manufacturer.
If that happened, it would instantly validate the entire tech thesis.
It would. And there's also speculation about a strategic defense partnership, given the new BURU defense subsidiary. If either of those happens, it could mean a capital injection without more dilution.
Looking long-term, the tech itself, it just remains a really attractive asset.
For sure. And ironically, their lean operating model could make them an appealing M&A target down the road for a bigger industrial player.
But we have to end with the risks. The immediate overriding threat is liquidity, which could just accelerate delisting.
Absolutely. And the risk that the revenue transition simply takes too long and competitors catch up while BURU is just fighting to survive.
It is a genuine bet on management's ability to survive the short term to unlock that long-term technological upside.
And this raises a really important question for you to consider. How do you weigh the value of that proprietary protected technology, a genuine competitive advantage, against a current management disclosure saying there's substantial doubt about the company's survival?
That balance.
That specific balance between revolutionary potential and acute financial peril. That is what will define this stock's direction in the next few quarters.
So what does this all mean for you? BURU presents a classic high-risk, high-reward scenario. You're balancing pioneering, protected technology against acute financial stress and massive dilution. It's a story defined by execution. Can the new management secure the capital and successfully integrate Orbit before that liquidity clock runs out?
Or will the debt and dilution overwhelm the technological promise? It's a nail-biting story to watch. Remember to subscribe to Smart Wealth with Joshua for more in-depth stock analysis every day. We'll be tracking those Q4 earnings closely.